Additional comments on capital raising, part 2. This is lesson 4 of class 1. In this lesson, we will review best practices for capital markets advisory and the applications of different capital markets solutions. Background. In part 1, we covered deal quantum considerations when advising on a capital markets deal. In part 2, we will continue to review additional considerations such as deal valuation and type of product. Deal valuation. Valuation is the client's current pricing in the market. When advising on private market deals, valuation is extremely important because the company's stock is not publicly priced on an exchange. Therefore, private company valuation is determined less frequently, as it only occurs at certain defined events. One such event is a priced capital markets transaction. Ultimately, the market determines the price, but in private market deals, investment bankers play a large role because they can have a significant influence on how the investor values the deal. The practitioners are responsible for positioning the client in the marketplace to ensure the highest possible valuation. Practitioners will provide evaluation guidance and support to help investors arrive at a desired price. Deal evaluation continued. Types of valuation in private company deals. This includes pre-money valuation. This is the company's valuation entering into a particular funding round prior to the company receiving capital. And then there's also post-money valuation. This is the company's valuation following a particular funding round, which equals the company's pre-money valuation plus the deal quantum. Side note. If the client's current pre-money valuation is lower than the client's previous valuation, it is known as a down round. A down round has severe negative consequences on the company's overall momentum and the equity position of current shareholders. This is a dilutive event. Capital markets products. The product type is an extremely important consideration to determine when advising clients. For instance, should the client take debt capital, equity capital, or a combination of both? The product type is determined after considering a wide array of different factors, such as the client's goals, current operations, current life cycle stage, and the overall state of the capital markets. Equity products. Equity capital. Considerations. The practitioner needs to consider why the client needs to raise equity capital and how much capital is truly needed. The practitioner will take the mandate to market and fetch valuation. From there, the practitioner will present all the opportunities available to the client, and the client will select the best possible deal that executes the mandate while relinquishing the least possible amount of ownership. Conclusion. The practitioners need to truly understand the consequences, positive and negative, of raising equity capital. The raising of equity capital affects the composition of the client's cap table. A strong cap table with mutually aligned participants is one of the most important factors for long-term corporate success. Therefore, equity capital advisory is as much of deal pricing and negotiation as it is selecting the right cap table partners for future success of the client's business. Debt products. Debt capital. Considerations. The practitioner needs to consider why the client needs to leverage itself and how much leverage is necessary. The practitioner will take the mandate to market and fetch lender interest. From there, the practitioner will present all the opportunities available to the client, and the client will select the best possible deal that executes the mandate with the least amount of burden. Conclusion. The practitioners need to truly understand the consequences, positive and negative, of raising debt capital. The raising of debt capital obligates the client to a lender and a legally binding debt agreement. Having a strong lending partner that is mutually aligned with the future success of the client's business is vitally important. Essentially, lenders can force borrowers to do certain things and to not do certain things through the implementation of covenants. Therefore, the practitioner and the client not only need to consider which deal they can afford from a financial standpoint, but also which lender will be most aligned with the client's future success. This is the end of class 1. We look forward to seeing you in our next class, which will cover closing deals and managing relationships.